President Trump's geopolitical gambits are still sparking uncertainty. So, how should traders prepare? Looking to bolster his legacy as a global peacemaker, President Trump has boasted he's ended at least 6 wars, but he's also warned of an economic war, as if he cannot get Russia and Ukraine to end their conflict. And despite promising a quick end to the war in Gaza, a resolution has been elusive. There's still plenty of geopolitical risk. Altaf Kassam is Europe Head of Investment Strategy for State Street Global Advisors. So you've previously worried about a potential energy price increase related to the conflict in the Middle East. Are you still long oil prices?
So at the moment, we're not long oil prices. What we've seen in the recent past is that any spikes have been pretty short-lived and the trend has actually been down. So what we'd look to do is stick with our gold hedges, look at defensive equities, look at high yield CDS in credit exposed nations. And with gold, if anything, we'd own some outright volatility to prepare for price moves in either direction, but we wouldn't be long oil itself.
Let's revisit those Trump threats against Russia. Should investors be worried about an economic war, and where would they be looking for impact?
I think the threat of an economic war is always out there, given the fast pace of Trump's policy agenda. So where we look is in credit. We think credit is the transmission belt of economic into markets. And for us, again, buying sovereign CDS in trade exposed nations, especially EM Asia. You've seen how India has moved towards China, possibly as a result, and looking at some of those high yield CDSs as well. So really for us, the action will come in the credit arena, maybe a little bit of currency volatility as well, but we'd stay away from being long the dollar at the moment.
So speaking on the dollar, global investors have reduced protection against a weaker dollar. Were earlier threats to the strength overblown, and can it still be trusted as a safe haven?
Yeah, we do think that the overall status of the dollar as a safe haven is still in question. We don't think it will have that safe haven status that it held for many years. You could argue at least 15 years since the financial crisis, if not longer. And we think that's being eroded. The credibility of the US administration is helping erode that. Also, the fact the Fed is probably on a bit more of a loosening cycle is going to take the dollar down a peg or two. So for us, we would not stay outright long the dollar. We don't think it will serve that safe haven role going forward. You see a bit of that coming from the Swiss franc and the Japanese yen, but they're expensive in terms of hedging with them. So for us, maybe just sticking more with defensive assets, maybe looking at curve steepeners and looking at CDS, as I said before, make more sense right now.
You have mentioned that gold continues to be your hedge overall against risk. Why are you still so bullish on the precious metal?
It's been up 50% or more since we published our previous report. So it's really held out well. It seems to be the go-to asset for a lot of investors to hedge with when they're thinking about geopolitical risk. Again, it should benefit, at least in nominal terms, if the dollar continues to weaken. And there's still a lot of demand from central banks in particular who have been buying it as a reserve asset. So in terms of flows, in terms of interest rate differentials, and in terms of market dynamics, we still think gold stacks up as a hedge.
More domestically in the US, the threat to the Fed's independence is a major concern. Is the bond market looking vulnerable?
If you looked at just the MOVE index, which is a kind of classic index of bond market volatility, there doesn't seem to be much concern. Where that concern is really being played out is at the very long end of the curve, say 10 to 30 years in US Treasuries. So we'd argue for more curve steepeners, especially with the monetary policy looking a bit looser in the short term. Add to that, excessive volatility, which we think will continue. Again, as I mentioned, the fast pace of policy action in the US, and it makes sense to be a buyer of payer swaptions as well. So we look at the volatility angle and the steepening angle as well, but we would not go outright long duration. A bit like I said about the US dollar earlier, we don't think holding long US Treasuries is that safe haven hedge anymore.
That was Altaf Kassam from State Street Global Advisors. Don't forget, you can watch more videos on Reuters.com.